And on today's show, life insurance indemnification, part 3 of this week's series on the Final 4 product review. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author and a backroom technician in Innsmouth. Let's get down to business. Well, the most popular product sold through life insurance, of course, is term insurance. And today I want to go on the spreadsheet provided to us by a company called EBIX. You know them better as Vital Quote. They use term and GUL, Guaranteed Universal Life, and they compare these products by duration. But before I get into that, I want to talk about the basic underwriting categories that are available without being into the substandard arrangement. So from standard and above, I have super preferred non-smoker, I have preferred non-smoker, I have preferred regular non-smoker, and I have standard plus and standard. And remember, even in the tobacco area, they have their own separate, where they have tobacco, non-cigarette, they have super preferred smoker, standard plus smoker, and standard. So there's many categories without going into substandard where we can look at and kind of get a range of where we fall depending upon the underwriting decision. And again, that comes back to each company, how their underwriting is, how benevolent it is, and is it going to be really benevolent somewhere around fourth quarter where we've seen a kind of a history of carriers kind of being a little bit more gracious towards underwriting and usually taking requirements off the table that maybe they normally wouldn't do throughout the year. Another thing I want to look at is term comes in many durations, and I mean you could really do a lot with this. It's 5-year, 10-year, 15-year, 20-year, 25, 30. There's even a couple out there that do 40. They're specific to that. And remember, there's a couple carriers that let you dial your own period. So you could be, I don't need it for 15, but I do need it for 12. I need it for 17. You can be very specific about dialing it down. One of the things you're doing when you're looking at this grid is, if you're just buying pure term, you may not care about the conversion, the ability to go to a permanent product. You may not care about the conversion window then. And you may not sit there and say, well, I really don't care about the product inventory, because if you're looking at a conversion term contract, you're going to look at the quality of the inventory that I'm going to convert to. So is their UL contract good? Is their index contract? Is it a par contract? I want to look at that first if I think I'm going to use the conversion window, or at least I want that flexibility. They're not all created equal. On the term spreadsheet, they're pretty close, but converting to a permanent policy could really change your thinking on which one you change. And just a little thought, I'm showing here a 10-year term period, and Ohio National, Protective Life, Savings Bank, and Banner are our top 4. Look at the difference between the first place, Ohio National, in this, and the fourth place. It's only about $50 a month. But keep in mind that the entire term market, from first place to maybe 80th place, that could be a 20 to 25% spread difference. So it's very important to keep in mind when you're looking at term that the top 4 to 5 carriers generally are going to be pretty close. Then it's just a battle of, is the underwriting going to take place? And you'll notice that there's certain carriers that show up in the non-smoking arena and they do not show up in the smoking arena. Let me give you some examples. In my male non-smoker, the companies that hit the grid more times than not, and this means I'm using my boilerplate of 10-year, 15-year, and 20-year, most of the companies that are hitting that grid for non-smoker male are Ohio National, Protective Life, Savings Bank, Banner, Genworth, Nicola, Principal, American General, and once in a while even Minnesota Mutual. When I'm looking at male smokers, that number is going to change to about 4 basic carriers. Now there's some anomalies here, Met's in there, and Nicola and Genworth, but the big anomalies I've seen are Lincoln Life, Pruco, Cincinnati, and John Hancock. When I'm looking at the female rates, it changes it quite a bit, because now I have some players that you're familiar with, but now here are some players that come online because they treat female mortality differently. Again, Ohio National, Protective, Savings Bank, and Principal becomes a player. On some of the longer 15 and 20 years on non-smoking female, I've noticed that Lincoln National, American General, Security, and Banner come online. And as I head out to the 20-year, I get a few more new carriers that I look at, Genworth, Nicola, and again, Minnesota Mutual. When I'm looking at female smokers, it really locks down to about 3 or 4 companies similar to the male. I'm again looking at Lincoln National, Cincinnati, Pruco, and John Hancock, with a smattering of other carriers around there, most notably probably Transamerica and American National, and a surprise to me at least, Columbus Life. So when I'm looking at a grid, I want to make sure if I care about conversion, I want to look at that option, and I want to look at the different categories, health categories, and see if the benevolency of the carrier will support it. When we come back from the break, I'm going to talk a little bit more about GUL and how to read that balance sheet or the spreadsheet, and we'll walk through some of the numbers and the players in that arena as well. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. Now I'm looking at EBIX's vital quotes for guaranteed universal life. And as you well know, after AG 38, there's been a huge reconfiguration of the market, and it's been completely contracting, and there's not that many players left. However, I want to go ahead and revisit the same kind of health categories that we're looking at even in GUL. And remember, if you're out there long in term at 30 years, you may want to look at GUL because there's more benevolent underwriting. So when I'm looking at health categories, I'm looking at super preferred non-smoker, I'm looking at preferred plus non-smoker, preferred non-smoker, standard plus, and non-smoker. And remember, some carriers actually write their rated cases on their standard plus platform, which can really be a premium saver. And keep in mind that a lot of the good table shaving carriers, especially in permanent products, they come online at table all the way up to tables 3, and there are a few carriers that actually go to table 4 now, to standard, depending upon lifestyle credits and the protocols that they'll use. So it's really good to see, maybe I could really get this to a standard plus on a platform. It's very possible depending upon the table shaving program that's out there. Now, when I'm looking at this, the problem is that there's so many maturity dates to choose from, and this is where you really need to think this through. Here's an example. I don't know if I want to put on, if I have a client that's truly super preferred, non-smoker, do I really want to go just age 90 when I think the actuarial numbers are going to be a lot farther out than the 2001 CSO? As an example, the Society of Actuaries VBT relative risk tables, that's the valuation-based tables, are projecting huge markups in mortality that we're going to be living longer. Do I really want to put a super preferred client on a 90 maturity date contract? I just think that you're asking for problems. Now, if this client was substandard, and we're talking about table C or maybe table B, then I can kind of see where you're saying, hey, I only want to cover up to their mortality. But when we have healthy people, I think you've got to be at a minimum of 100, and I think probably you need to go farther out. In our grid, we can reflect age 90, age 95, age 100, age 105, and age 120. Depending upon the carrier, that age 100 premium may also be their age 120 premium. So when I'm looking at that and I'm looking at a difference in premium, I may say, I'm not going to take a chance at 90, 95. I'm going to just get that carrier that goes not only to age 100, but the premium continues on the same all the way out to 120. The healthier the client, I'm going to be looking at a longer maturity date. And keep in mind that some of these carriers, even though this is not really a cash accumulation play, even after AG 38, some carriers are still giving away pieces of their death benefit depending upon the rider and what it comes with. So there's some, I wouldn't use the word liquidity, but there's some access to it. But strictly buying death benefit, I'm looking at age 90, 95, 100, 105, and again, all the way out to 120. Once I understand how long I need to keep the coverage in place and I see my client's mortality, then I can figure out how much should I spend and how much am I willing to spend. That'll be the distance on how we go all the way out to maturity. Look at the distance here. I have an age 90, 4812. By the time I get to age 100, the premium is about $800 more. I ask you, is the risk from going from age 90 to age 100 worth that difference in premium? And that's what you always have to look at when you're looking at these grids. And especially if you're going to go out to a very, like in this Symetra's example of age 120, that premium goes all the way out at 65.37 versus age 90, which is a 30-year spread. So if I'm at 48.12 and Symetra's at 65.37, that spread is actually reflecting a 30-year beyond what our number one ranking is. It's always going to be about how long do I think my client's going to live? Do they have a permanent liability? And that's why I'm looking at GUL. Then I can start to factor in the health and the duration of these categories. Well, that's our show for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? You can view any of our past episodes right out at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.